In 2021, you could buy a median home for around $300,000. By 2023, that same house cost close to $375,000. The Fed did not print new dollar bills to make that happen, but what it did instead is a large part of why your rent went up too. Right now, somewhere in a conference room in Washington, a handful of people just voted on a fraction of a percentage point, and by tomorrow morning, billions of dollars will exist in the banking system that did not exist yesterday. Nobody printed it. Nobody mined it. Somebody typed a number into a ledger, and the number became real. Here is the proof of how large that ledger has grown: $7.2 trillion. That is the current size of the Federal Reserve's balance sheet according to the Federal Reserve's own weekly reporting, money that mostly never existed as paper or coin. That $7.2 trillion did not build up slowly. Roughly $4.8 trillion of it appeared in the 2 years after March 2020 alone, according to Federal Reserve data reported by Reuters. That is more new money created in 24 months than in the Fed's first 100 years combined. Economists call the foundation of that system high-powered money, the base layer of reserves and physical currency that every dollar in your bank account is ultimately built on top of. It is a plain enough term. It also hides an enormous amount of machinery. The lazy explanation is that the Fed prints cash in a basement somewhere. It doesn't, not really. Physical currency in circulation totals roughly $2.4 trillion according to Federal Reserve data, a third of that $7.2 trillion balance sheet. Whatever is actually happening, it is not a printing press. It is closer to a valve. So today we're asking 4 questions. First, what does the Fed actually do, mechanically, when it creates money? Second, how does that money travel from a Fed ledger into your paycheck and your rent? Third, who gets it first and who pays for it later? And finally, what actually breaks if that valve is left open too long? This matters now because the valve has moved more in 5 years than in the previous 50. The US economy is worth $30.77 trillion in 2025 according to World Bank figures, growing at 2.16% a year. Inflation sits at 2.95%, according to the Bureau of Labor Statistics. Unemployment is 4.2%, per the same agency. Those numbers look calm. They are calm partly because of decisions made inside that valve, and partly despite them. Federal debt runs to 115.77% of GDP, while output per person sits at $90,026.52, according to World Bank figures, a debt level that makes every future turn of that valve more consequential than the last. That is not a small machine to be experimenting with. Picture the banking system as a tank, and bank reserves as the water level inside it. The Fed cannot force banks to lend, spend, or hire. It can only raise or lower that water level. When the Fed buys a treasury bond from a bank, it does not send cash. It credits that bank's reserve account at the Fed with new reserves, new water in the tank, and the bond becomes an asset on the Fed's own balance sheet instead. No presses were harmed in the making of that $1 trillion. That reserve account sits at the center of everything. Total bank reserves in the system run near $3.3 trillion, according to Federal Reserve data. The Fed pays interest on those reserves at a rate tied to the federal funds target, which held at 5.25 to 5.5% through most of 2023 and 2024, before cuts brought it toward roughly 4.5% by early 2025, according to CNBC's coverage of Fed decisions. That rate is not a suggestion. It is the overnight price banks charge each other, and it ripples into mortgages, car loans, and business credit within days. There is also a quieter lever, the discount window, where banks can borrow reserves directly from the Fed when nothing else is available, a backstop the Fed rarely advertises and banks rarely admit to using. Quantitative easing, the program behind most of that $4.8 trillion pandemic expansion, is the same mechanism run at industrial scale. The Fed buying not just short-term bills, but mortgage-backed securities and long-dated treasuries, pouring reserves into the tank to push longer-term borrowing costs down when the short-term rate alone was not enough. It is not free money. It is a rearrangement of who holds the world's safest assets, done at a scale of trillions. The tank does not feed the economy directly. Banks do through pipes called loans. A bank holding new reserves can lend more, priced off the federal funds rate the Fed just moved. Total U.S. money supply measured as M2 runs near $21.5 trillion according to Federal Reserve data, roughly 3 times the base of high-powered money the Fed directly controls. In March 2020, the Fed cut bank reserve requirements to 0 according to Reuters coverage of the announcement, meaning the real limit on lending today is bank capital, not reserves at all. Most viewers were never told that changed. The transmission is neither instant nor even. Mortgage rates moved from under 3% in 2021 to over 7% by 2023, according to CNBC's tracking of Fed policy. Credit card rates crossed 21% in the same window, according to Federal Reserve figures, the highest recorded since that series began. A small move at the top of the tank becomes a large move at the end of the pipe. That is the entire point of the mechanism. But timing decides who feels that pipe first. That answer is next. Economists have a name for this ordering effect, the Cantillon effect. The idea that newly created money changes prices for whoever spends it first before the rest of the economy adjusts. Trace it in real time. In March 2020, the Fed's first pandemic-era purchases went straight to bondholders and banks, crediting their reserve accounts within days. By April, those same institutions were sitting on portfolios that had already repriced higher as the S&P 500 began a climb that would end the year up roughly 27%, according to CNBC. By May, that fresh capital was chasing yield anywhere it could find it, and real estate was one of the few assets still offering one. By June, cash flush buyers were bidding above asking price in suburbs across the country, and landlords, watching comparable sale prices climb, started raising asking rents to match. The grocery bill and the rent renewal were always going to be last in that chain. They just did not know it yet. The top 10% of earners hold 30.7% of national income, according to World Bank figures for 2024, and that same group disproportionately owns the financial assets that move first when reserves expand. Median home prices climbed roughly 2022 to 2020 and 2023, according to Reuters, while average hourly earnings rose about half that fast over the same stretch, and inflation itself peaked near 9.1% in mid-2022, the fastest price growth in 4 decades, according to the Bureau of Labor Statistics. By the time a paycheck catches up, the money has usually already changed hands twice. You may notice a pattern. This is not a conspiracy. It is closer to plumbing. Water finds the nearest opening first. The Cantillon effect tells us who benefits. But that same wealth concentration also shapes the political math of the debt problem waiting in the next section. When assets inflate faster than wages, the debt burden feels entirely different depending on which side of that gap you stand. And that is where the real pressure builds. Here is the darker arithmetic. Federal debt held by the public has climbed alongside nearly every round of reserve expansion, and it now sits at 115.77% of GDP, according to World Bank data, surpassing the roughly 106% recorded in 1946, according to U.S. Treasury historical figures. The Congressional Budget Office projects interest payments on that debt will exceed $1 trillion a year by the back half of this decade, overtaking defense spending as a federal budget line item. That is not a rounding error. That is a structural claim on every future budget. None of this happens in isolation. Foreign governments, led by Japan and China, hold more than $2 trillion combined in U.S. treasuries, according to U.S. Treasury data, which means the whole system runs partly on foreign confidence that the dollar will hold its value. If the tap stays open faster than the economy grows, the result is not abstract. It is the 9.1% inflation of 2022 translated into grocery bills and rent renewals, and a Federal Reserve forced into the fastest rate hiking cycle in 40 years, 525 basis points in 16 months, according to Fed data reported by Bloomberg. Growth this year sits at just 2.16%, according to the World Bank. That is not much cushion if the debt load or the next shock forces the Fed to choose between price stability and financial stability at the same time. The math does not close by itself. It would be easy to end there and leave the impression that the valve only has one setting, open. But the last 3 years argue otherwise. Between 2022 and 2024, the Fed drained roughly $2 trillion out of that $9 trillion balance sheet peak, according to Federal Reserve reporting, while unemployment held near 4.2%, according to the Bureau of Labor Statistics, a disinflation from 9.1% down to 2.95%, without the recession most forecasters expected. Fed officials and outside economists alike have started calling that outcome a genuine soft landing, and so far the data backs the label. It is proof the tank can drain without running dry. None of this is a call to buy anything or sell anything. This is plumbing, not a stock tip. But the direction is worth watching. With growth at 2.16%, inflation at 2.95%, and debt at 115.77% of GDP, the Fed has far less room than it had a decade ago to reopen that tap aggressively without consequence. Fed officials' own projections released after each meeting currently pencil in only gradual moves through the rest of the decade according to Reuters' coverage of the Fed's rate outlook. Expect smaller, slower adjustments from here, not another $4.8 trillion surge, unless a genuine shock forces the Fed's hand. The Cantillon effect ordering does not disappear just because inflation has cooled, it only pauses until the next expansion, whenever that arrives. The $7.2 trillion balance sheet we opened with is not disappearing. Neither is the gap between who gets the new money first and who pays last. The same gap that turned a $300,000 house into a $375,000 one. The valve can bend without breaking. Right now, bend is all it can do. Watch the next Fed meeting, and you will see a system learning to live smaller, a fraction of a percentage point, decided in a room, arriving in your mortgage statement a few weeks later. Thanks for watching. Mind your reserves. This video is for educational purposes only and is not financial advice.